Hey folks, Dan Frio here, the rate update. Right now we're going to talk about Zillow and how you might be able to learn some lessons from Zillow and how I think it's going to really help the housing market drive down prices. So don't go away. That's what we're going to talk about next. Well, the goal of this video is to make sure you don't become like a Zillow. And what I mean by that is Zillow, they make a bazillions of money. And then they got arrogant like people did back years ago in the 2000s, early 2000s, and started, okay, I'm going to buy houses and fix and flip them and make bazillions of dollars. It's not as easy as a lot of people think. So let me let you hear it from Jim Cramer. And some of you guys like him, some of you guys don't, but at least he was on point on this one. So take it away, Jim.
Zillow Group down 15% this morning, obviously getting out of the iBuying business, $500 million write-down, cutting a quarter of its workforce. This is what Jim said about that home buying model in, is this right, April of 2019?
Yeah.
Take a listen to this.
Maybe Rich Barton can orchestrate a phenomenal turnaround at Zillow. I'm glad he's running things again. But I think this headlong rush into the house flipping business could prove to be very risky. And even if it works, there will absolutely be some brutal speed bumps along the way. Yeah. Wow.
Great information, Jim. Now let's get on to this. Zillow. What was Zillow and a lot of other big companies doing in this market? They were competing against me and you. Okay, so you got hedge funds, you got Zillow, you have these big companies coming in with all this money and arrogance thinking, we're just going to take over the housing market. Well, they might want to rethink that because it's not that easy being a landlord. Okay, so we just saw that Zillow basically lost their ass in the home flipping market and they're getting out of it. Now, what does this mean going forward? Well, I love it. And the reason why I love it is if Zillow failed, which is the renowned real estate entity out there, when you think of real estate online, you think of Zillow. Now, you also have hedge funds. Hedge funds might have a little more knowledge in this, but they might not. Okay, so hopefully the hedge funds will start realizing this game might be a little harder than we think in today's world. Why? Well, we already have restricted supply out there because of, I'm going to say it, forbearance, COVID. Those two things really halted this business. I know it. I do it every day. I've been doing it for 30 years. Our business last March, April, May, when things should be killing it, was so you have all these houses that people are looking to buy. COVID's starting to come out of play, and people are like, I really want to buy a house. Our pre-approvals were out the roof. Our contracts, not much. Because people couldn't find a house or they were in bidding wars. And a lot of those bidding wars came back that the appraisal wouldn't substantiate what you offered. And now a lot of people backed out. And then it's just been, just a round robin with that whole thing. It's like we're chasing our tails. Here's what I'm taking out of this, guys. I'm hoping, well, first off, we know Zillow's going to be out. And they're going to put about 7,000 houses on the market. That's only a trickle, but it's a start. The next thing is hopefully hedge funds get a little more cautious on what they're doing due to this Zillow data. Okay, that's the first two things. Now, because of that, there should be less bidding wars on properties. On top of that, what also do we know? Well, forbearances are coming to an end. Those people are going to do what? Well, they're going to bring their house current on the mortgage. They're going to kick the can, or they're going to say, you know what? I'm just going to sell my house and go from there. Okay, so that's one thing we have going for us. The next thing we have is COVID and everything starting to lapse now. So come springtime, think of February, March, April, when we usually have a robust season, where last year's was, I see this spring season being phenomenal. So you're going to have a lot of people that are in forbearance put their houses on the market. I'm saying in the tune of about 500,000. Then we're going to have Zillow not competing with you. I'm still going to say we're going to have hedge funds not competing with you because of this that happened in Zillow. What does that mean? Well, that means more houses on the market, less competition should stabilize the market. That's what I've been talking about. Now, do I see price declines? I don't. I see prices coming back in line. So if you overpaid substantially, you might be a little underwater at this time. I think it's going to be few and far between, and you're going to see the robust economy and the robust activities in home purchases come the first of the year starting to really take over. Mortgage rates are going to tick up. And if you watch this channel, you know that every day. Are they going to get out of hand? I posted a video last week where rates should be if we're in a normal market, 4.75. It's not a normal market. It's going to take a year or so to get out of this. Where do I see rates come springtime? About mid threes, mid to low threes, maybe 3.25 to 3.5, 3.625, that range. And then end of next year into 2023, we're probably going to see everything starting to subside, the Fed stepping in, doing what they need to do, upticking interest rates and everything else. So I think my analysis is going to be in the springtime, we're going to have a very good, strong market. Rates are still going to be in line in the 3.5 range. And then that's your best time to buy if you're still on the fence. Come the latter part of next year, the economy is going to get better and better and better. Each month it's going to grow a little bit more and more and more. Then it's going to get to a point where the Fed's going to start raising rates. That's going to start pushing bond prices or bond yields up and mortgage rates up along with it. So if you're in that process, you're like, hey, Dan, I want to know where I can fit in. Can I get pre-approved for a house? Can I get this? How much do I qualify for? I'm going to make it simple for you. I'm going to show you the website that I have. Also, if you're in the process right now buying a house or refinancing a house, how we might be able to save you some money. What I need you to do is send me anytime that you have a loan application in with a bank and they pulled your credit, within 3 days, they have to send you what's called a loan estimate. It goes over the rate, the fees, and everything else. You're probably going to miss some of the fees in there and the cost. You might even be getting a little bit gouged on that rate. So what I'm going to do for you guys is I'm going to review that and see if there's another program out there that maybe can get you a lower rate, lower fees, or all the above. So I want to be your mortgage consultant. So how do I do that? How can you reach out to me and my team to get help? Well, go to therateupdate.com. If you have your LE, you're in the mortgage process right now, go to resources and upload your loan estimate. You're going to just click here. You're going to just put in some information in this message section that it prompts you to put in. Please give me a little bit about what you're looking to do. I do need a contact information. I'd love to get your phone number and let me know what your credit score is. Okay, so that's that part of it. But if you're like, hey, Dan, I need to get pre-approved, or in the spring, we're going to look to buy a house. It's never too early to get started. Why? We can help you with a lot of things. Let's say, for example, you don't know if you have enough money for the down payment. We'll walk you through and let you know how much you're going to need. You might be on the brink of getting a better rate because of your mortgage or your credit score. Let's say, for example, a 719 credit score and a 721 credit score, big difference in rates. 739 credit score versus a 740, difference in rate. So if you have a lower credit score, the higher the rate. How we can help you guys is we're going to look at your credit and we're going to give you advice on how maybe you can get your credit scores up. We can do all this and much, much more. So how I need you to reach out to us is give us a call, 844-775-LOAN, or schedule an appointment right here. You're going to click that, schedule the day and time at your convenience, and we'll make sure we attend that meeting to answer any and all questions you have. So that's it for today, guys. I hope you learned something valuable. If you did, give me a thumbs up, subscribe down below, hit the bell every time I post a video. You get an alert. I'll see you tomorrow. Bye-bye.